Hey there, this is Scott. Welcome to the video. It's Thursday, which means we get together and we talk about beating the market. Now, if I sound a little bit different, it's because I'm on location in Miami. I may or may not be in Miami going to a pro tennis tournament, and I may or may not be watching Federer. I can't confirm or deny that, but I do not have my normal setup, so I apologize if the audio is terrible. Leave me a comment, tell me you hated it, and maybe I'll even re-record it for you, but I think it'll be okay. But anyway, regardless, we're going to talk about ways to make trading without stops. We're not going to use stop losses in this week's video. How to make trading without stops even better, because it's pretty darn good as it is. Three things today are we're going to talk about trading without stops. We haven't talked about it in a while. If you've watched all the videos, then you know we've talked about our fair value system, which is finding the fair value of an instrument and then trading back up to it. We've talked about it before, but if you didn't know, it's the best way to consistently make money. Now, there are other things that come along with that, and we'll talk about that shortly. Number two, the key to trading in this fashion is to have a plan for the bad times. And if it's review to you because you know this style of trading, then you need to hear it again. And if it's not review, then you need to hear it the first time. You understand? I cannot stress this enough, but I'm going to try anyway to stress it enough. And sometimes even the bad trades can turn out very good, or you can just avoid them altogether. But we'll talk about that too. Okay? Now, we like to spend a few seconds, a little bit of our video getting to know me. Here's a shot. I'm feeling happy yet pensive in this shot, but again, getting to see a picture of me and putting that with the voice, I think it helps us communicate and get my information across. So that's me, and now we're moving on. I also cannot emphasize enough how great it is to trade without a stop loss. What does that mean? That means you enter a trade, go long, go short, doesn't matter, and you're going to take that trade until it hits the target. It doesn't matter if it hits your stop loss because there is no stop loss. Get it? So that means it can run far, far away from you and go the wrong direction. I get that, but the goal here is to have a methodology or a style that allows you to get in with a high percentage of likelihood that it's going to go your way. So you're getting in a situation where it's probably going to do what you want it to do. And the greatest example of this is buying on sale. Warren Buffett does not have a stop loss. He buys it because he buys it on sale and he wants it to go up. What are the chances that something he buys will go up? Very high. And he will wait as long as it takes for it to get there. Get it? That's the best example is Warren Buffett, and we know how successful he's been. But what's so great about it specifically? Well, let's not give a Warren Buffett example. Let's talk about it. First of all, when you trade this way, everything is a winner. Think about that. Every single trade you take is going to win. At least that's the goal. And like I just mentioned, if you have a good entry method, you don't really need an entry method at all to trade this way, but if you have a good entry method, and a great example is value investing or trading back to fair value, if you buy something on sale, it's going to go up. How many times do I need to say it? Well, I'm going to keep saying it. And if you have a good entry method, if you're buying stuff on sale, then the wins come fast and they come furious. Although they don't have to be furious, they could just be kind. Fast and kind. What are some of these no stop out entry methods? Well, we've mentioned fair value several times already. You could also use divergence. My good friend Rob Booker uses an indicator he made up called Knoxville divergence. And it means that price went down, but the indicator went up. And that's a very short version, but it doesn't seem like price is jiving with what the indicators say. Something is off, which usually means there's a move in the opposite direction forthcoming. That's what divergence means. It went down lower, but not as extreme. It's a fake down lower. See what I'm saying? And so it's going to go up. Or you could just wait for extreme indicator levels. Find an indicator you like and wait for it to get an extreme reading. If it's RSI, wait for it to get down to 2 instead of 30. If it's a CCI, wait for it to go down to negative 200 rather than negative 100. If it's percent B, percent of the Bollinger Bands, which we'll talk about, same thing. Wait for an extreme indicator level reading. In all of these circumstances, it appears that the price will go the other way because we've waited for something extreme, which gives us a high percentage, which leads to all the winning, right? So if you have a methodology that increases your likelihood of price going the other way, guess what? It's going to go the other way. It's going to snap back for you in the proper direction most of the time. And that's why I say the wins come easy. They do. Ridiculously easy. It will make you cocky, confident, arrogant, whatever the proper emotion is to describe the fact that you win all the time. And understand that if you pick a good entry method, something that makes sense, you can go long periods of time, and only thing you're going to experience is a winner that goes really quickly. Oh, look at this, another boring winner. This is an example on my TradeStation platform from the New Zealand dollar using the fair value method entry, whatever you want to call it. I waited for price to get extreme. You can see it went down toward the bottom of the screen and then it snapped back. Look at that, almost immediately, right? Very, very quick. And that's an example of the way it goes with this method. Now, that all being said, if you're new to trading or if you're not new to trading and you want to grow an account immediately, then there's nothing else I can tell you. No stop trading is the way to go. If it wins all the time, you're going to grow your account, right? There's no better way to make money immediately than trading without a stop loss. And as I mentioned, you don't have to have a very specific methodology, really. Even random entries can work great for a while. Just wake up in the morning and press a button, long or short, doesn't matter. Make your profit target small, and guess what? It's going to work out almost every time, okay? This style of trading works. You know that old saying, and people have said it and I've said it, well, I traded in demo or I paper traded and everything worked great, but then as soon as I went live, everything fell apart. This will not happen to you in no stop trading. Almost, and almost is the key word, almost certainly you will get winners right away. Okay? Not guaranteed, though. It's not guaranteed. But your likelihood is in the 90% range that you'll start getting winners right away. But it's not 100%. Do you hear me? It's not. But there's no other way of trading that can give you a 90% chance of starting to win right away. There's just nothing out there nearly as good. So if that's so great, Scott, who's talking to me? Is someone else in this room? Anyway, if that's so great, then why trade anything else? Well, the bad times are the reason. Trading without a stop loss means things can go the opposite direction, and there's nothing to stop it. Hence the definition of stop. No stop trading works better than anything else you'll ever come across or that's ever been invented until the bad trade comes along. So if you're buying something on sale, let's say, and I just said it's a great way to trade, and it is, if you're buying something on sale and it stays that way, danger time is upon you, right? This is a very, very dangerous time. Why? Because a bad trade or a bad series of trades handled poorly means the end. Pause for dramatic effect. Here in Miami, a Miami dramatic effect. A bad time in the market or a bad series of trades, once again, means the end of our accounts. It's over. And if you happen to trade an instrument that trends for a long time, such as the euro dollar, if you try to trade without stops on the euro dollar, it's going to be great. And then when it's not great, whoo, Nelly, it is really, really not great. And it will take everything. Now, I just had an example of this in the fair value system with the dollar Canadian, USD CAD. And I talked about it a little bit yesterday in the newsletter. We're going to talk about it again. So what happened? Well, on June 28th, 2017, last year, it went extreme, just like it showed on a chart. It went down into an extreme, and I only go long with this system, so down is proper. It's on a 15-minute chart. Price went extreme down, and the robot bought it. And then it kept going down, so it bought it again. And then it kept going down, so it bought it again. And it kept going down, so it bought it again 4 times. The robot took all of the entries it was allowed, which is 4. This robot's not allowed to take more than 4. Well, all 4 were taken, and guess what? Did it snap back? No, it went down to nearly historical levels. Like I've tested the dollar Canadian all the way back to 2003, and this drop was as bad or worse than anything we've ever seen on the dollar Canadian. Historic. History was made. So this robot was in 4 positions, and it was going the wrong way. What do you do? Pop quiz, hotshot. What do you do? It's from a movie. Well, one thing you can do is just trust the research and do nothing, which is my particular method to handle this, and that's what it would have been every single time on this particular strategy. Is I'm going to trust the research. And if you did do nothing, hey, look at this. You were rewarded with a profitable ending to all of this on 3/16/2018. About 9 months of blah ended in profit on 3/16/18. You want to see it? Let's go see it. Here it is. Here's that magic moment, and I've expanded the screen. Look at this. See this? These are the trades coming from all the way back in 2017, and it's drawing a line and finishing up right there. Here are some trades that were above the price. Here were some trades I took that were below this price, and when you add them all up, and it made a profit. A very small profit because we're using a small trade size, but a profit nonetheless. Now you can see that since then price went up significantly higher. So we could have waited and gotten even more money, but that's not what we're talking about. So it did end. We just saw it. That's kind of a long time. Is there anything else we can do except wait 9 months? Yes, you can go to a daily chart. Now, before I talk about any of this, please do not rush in. Testing showed this should only trade 4 times. We have traded 4 times. Be very careful. 4 doesn't mean 10 entries, right? When you start piling on extra entries beyond your research, things can go way wrong, way fast, and way terrible. I don't even know if that makes sense, but it makes sense to me. So do not rush in. Don't be a fool and rush in. That's a song. Adding to this position, going beyond the limit, adds to drawdown if it doesn't turn around. Okay? So be picky. Wait a month or 2, or wait for an extreme drop. This was a drop of, 800 pips-ish. I mean, it dropped a ton. So wait. Act like you only have one more trade to take. You know, what Warren Buffett said, if you only could take 10 trades in your lifetime, you would be picky, wouldn't you? I'm telling you, if you're going to try to get out of it manually beyond your research, be picky. All right? But let's talk about one way to do it. Go to a daily chart. So now we're going to get out of it. We started on a 15. Now we're going to go to a daily chart. We're going to keep this calm. We're going to only get one more entry, 2 maximum, but let's say only 1. I'm really only going to say 1. So we got to be picky. Set your Bollinger Bands, because Bollinger Bands are a great way to measure extreme moves in price, and set it to about 100. On the daily chart, it doesn't really you don't really need much more than that. You don't need to go back farther than 100 bars to get a nice extreme reading. And you can just use the basic default of 2 and -2, standard deviation. So put that on your chart, and if price goes going the wrong way, Then when price comes out, then buy one more. So let's go to our trade station and let's take a little look at what I'm talking about. Now this dashed line is where the robot got into its first series of 4 trades. So I'm at my max. And as you can see, it kept going down. This orange line is the bottom of the Bollinger Band I mentioned. Okay? I know there's a lot going on here, but it's okay. The blue are weekly pivots / monthly. Actually, these are monthly. 3 means monthly, 2 means weekly. So these are actually monthly pivots. We'll talk about that in a second. This is a fair value line. It's a 650 period fair value line. We'll talk about that. But we don't need any of that, right? Let's go ahead and remove that trend line that I just drew for you. And let's talk about this. Price went down, went down, went down, went down, went down, went down. It's clear. It's cleared the Bollinger Band. You see this? This is extreme. And we would have waited, right? This was the end of June. So we would have waited until nearly August, July. So we've waited 2 months. So we've waited. We're picky. It wouldn't have been the worst thing to do to get in right here. See how price enters back inside? It's not the worst idea in the world. Now, it went our way, and that deficit would have lessened quite a bit. But as you can see, if you get in too early, it did make another historic drop down. And so, not that great. If you would have added here, you would have added a drawdown. But you can see that off of this second extreme move, price went all the way up. See that? Isn't that fantastic? But getting back to the point, this could have been a possible entry, but you can see not every entry is perfect. Well, if you would have waited, listen, I see that, but it's going my way. There's no need for me to get back in now. If you had waited to here, and again, how are we going to know in real time? It's tough. That's why we're talking about it. This entry would be monstrously profitable. But how do you know the difference between these two? That's tough, right? This would have definitely added profit. This would have added a ton of profit. I'm just giving you one possible way to get in. But it's still a little bit subjective, is it not? So you could do that, and it would have helped. Either way, it would have helped. But you can see that one was better than the other. Or we could use percent B, percent on the Bollinger Band. All this does is measure how extreme it goes beyond the Bollinger Band. It's a percentage that's calculated on how much worse it gets outside, how extreme it gets. Hopefully this is on your platform. I've seen it pretty much on every platform. But on TradeStation, you can see that normally, see that's between 0 and 100. Anytime it gets above 100 or below 0, that's extreme. I took it out even further and went to 120 and -20. And as you can see in all of this, it was here that price went into extreme, not only below the Bollinger Band, but extreme on the percent B, and it even got extremer. That was another possible entry that you could use, right? Put an indicator on your chart. You can see it's for 100 Bollinger Band, 2, so it's the same Bollinger Band. It's the percentage of craziness outside of the Bollinger Band. You could have made an entry here, but you still would have had to wait, and it wouldn't have gotten us out. Might have gotten us out, or at least given the opportunity to get out here off this climb. But again, it's not that great. You could have waited for here, might have been a little better. But you can see it never really hit the 120 mark again. Now, if you had waited in a time, same thing. Remember how if we waited for the second Bollinger Band breach, we would have gotten a great entry. If we waited for the second extreme, we would have gotten an amazing entry and made a ton of cash. But again, little subjectivity. Not my favorite. I'm just giving you ideas. Or we can just hold on. Don't even add any more trades, because you can see it can be a bit subjective. Just wait. Wait for weekly and or monthly pivot levels. Right? So here is a monthly pivot level right here that was missed. And if you don't know what missed means, it means price didn't touch it. See that? Price didn't touch this level. Otherwise, every other level was touched on the chart except for this one. We could have just wait for this level. Don't take any more trades. Just wait for a weekly pivot level. That is a very possible thing to do, right? And as you can see, Recently, this is when we're doing this webinar, it went up almost to that monthly pivot level. And guess what? If I change it to weekly, dun, 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 there was a missed weekly pivot right here at 3059. So again, you could have taken an entry here or here. You could have taken an entry here or all of that, right? If you have a ton of room in your account, which the combination of position here, and wait for a pivot, holy moly, that's powerful stuff. But let's say, well, this is too subjective. I don't know. Waiting just for the most recent missed pivot right here, 3059, you can see it got back to 3059, right? So just do nothing is fine, right? And the last thing I'll show you, if you remember on the list, put a long-term simple moving average on your chart. I use 650 and above. 650 is pretty much my favorite these days, just based on testing. I've used the 800 simple moving average that I learned from Rob Booker again. Rob taught me so much. But the 800 simple moving average is what I'm trying to say. We've used that for a long time. He and I both have. I like the 650 now a little bit better, just again based on the research. But that line right here, I lengthen this out. See this blue line? That's a 650 period moving average. And you can see that price went back up to that fair value mark, and then it's dipped recently. Whoa, look at that. So if you don't like weekly pivot levels, put a long-term simple moving average on your chart, and it can get back to that also. Any of those would have worked. But as you can see, you have to have a plan because it's pretty scary. All right, bottom line. As I mentioned, the good times are good with this strategy. They don't get better. Nothing beats this strategy when it's going right. The bad times, though, are extremely dangerous. And if you're using a stop loss system, you're not going to stop out on one trade, most likely. It's going to be a series of paper cuts, maybe. But when you use stops, you're going to have time to get more and more and more trades. You get into one bad series of trades with this, and it is over. So have a plan. So what's the plan? Well, extreme readings on indicators, but you saw how they can be a bit subjective. But if you limit to yourself to one or two more entries, you can probably get away with it. You can see that you would have on the dollar CAD, even though that was an historic drop, you could have gotten away with it and made a ton of money. Or just use fair value targets or Bollinger Band to get out of trouble, right? Or Bollinger Band meaning the center of the Bollinger Band, right? So use fair value targets or the center of a 650 Bollinger Band, or if that's confusing, now that I'm saying it, maybe that was confusing, just use an SMA. I was thinking the Bollinger Band with the midline, I use that a lot as my fair value line. So I can have the Bollinger Bands on it. So sorry if that's confusing. You don't need the Bollinger Bands. You can just do the simple moving average if you want. Either way, hope that's not confusing. But use fair value targets like the SMA or fair value targets like pivot points and just hold on, right? Well, you can, again, I gave you the combo. You want to enter on an indicator and then use fair value targets? Good grief. That would have made a lot of money. How much is a lot of money? Well, I'll show it to you. And I wasn't going to show it to you. Let's do it. Here are the entries that my robot took. Here is an entry that, let's go back and let's just pick an entry, all right? Which one do you want, huh? Which one do you want? Do you want, let's do, you want to do the second one? Okay, let's do the second one. Let's do entering back into the Bollinger Band. See the close? Maybe you can't. It's 2184, all right. So what if we took one more? 2184. Okay. Now understand this uses one mini lot on a sample size $6,000 account or $10,000 or a little bit less. A typical profit for on a $6,000 account. Well, let's just show you. I'm not even going to tell you. This is a $900 profit when the profit target on this particular currency pair is $8. Now, you ramp it up as high as you want and any account size you want. I'm just saying on a $5,000 or $6,000 account, this could have been a humongous. I mean, if you're trading conservatively and you're trying to make, 10, 20% a year just trying to beat the market, this is an entire year of profits, even if you don't trade anything else. So that's why I said if you add one more entry and use fair value, meaning pivot points or the SMA or the middle of the Bollinger Band, look at that. You can make almost a year's worth of profits on one series of trades. So that's what I mean. That's what I mean when I say when it gets bad, there if you use way outs or can be patient, ways outs or patient, if you can just hold on, it can be very, very profitable. All right. Hopefully that's useful to you. It's very interesting to me. If you want to talk about any of the courses, you can email me. This is not correct. YouTube is going like crazy, over 1140 on YouTube now. If you want to talk more about these topics, you can always sign up for my newsletter, and that comes out every Wednesday, and you can find that by going to scottwelsh.me. All right, that's enough from my Miami correspondence. I will be back next week with the same old video, same old audio, and same old topics of fun. I'll see you then. Bye for now.